Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Chris Rawley. He is a retired Navy Reserve captain who has a 30-year military career. In 2016, he founded Harvest Returns, a firm that offers passive investors the ability to invest in farming and agriculture. So thank you so much for coming on the show today, Chris.
I'm very happy to be with you. Thanks, Charles.
So you have a pretty in-depth background, both personally and professionally. And if you don't mind going into that before starting Harvest Returns and what led up to that.
Yeah, I'll kind of talk about my on again, off again experience with real estate and real estate investing. Starting with my very first job when I was a kid. My father was one of the very first developers of self-storage in North Texas in the early 70s. And so I spent a lot of time cleaning out units and painting units and weed eating and things like that. And, hearing about break-ins and all the fun things that come along with owning that asset class. And so that kind of got me a little touch of real estate. And then after college, I joined the Navy, served for several years on active duties, destroyer, worked in a Pentagon, and then my first job outside the Navy was I worked for what's now JLL, but then was Jones Lang LaSalle. Worked in commercial property management. Not a very exciting place to be right now if you own a big office building, but it was great development experience. And after that, I kind of caught the real estate bug, and I started investing in single family homes and duplexes and small office and things like that. And eventually I became bored is not the right word, but I was looking for something new and challenges related to real estate. And so I started thinking a lot about farming and agriculture. And this is about the mid 2000 teens, and decided I wanted to invest in a farm or a ranch because I had sort of moved out to the country and drove past these every day and wondered how people made money with them. Turns out I didn't have a farming background, didn't have a ranching background, didn't know anything about it whatsoever. I was just kind of intrigued by it. So did some research on how to invest, and there weren't a lot of good ways. So I skipped several steps and just decided to start up this platform to allow people to invest in farms and ranches and agriculture related businesses. We did that in 2016, and we've been doing it ever since. And we've invested about $40 million in quite a few different farms and ranches and projects. And that's what we do now.
Can you explain a little bit about how Harvest Returns is structured? So really, what is your role in the project, and how are you connecting investors with opportunities?
Yeah, so the way a typical project works for us or deal works is we have a pool of investors, farmers that want to raise capital for their ranch, either debt or equity, to go and buy a new piece of land, farming equipment, cattle, operating expenses, whatever it is. They approach us. We look at the merits of the deal, decide if it's something that might be interesting to our investors, and then we basically promote that to our pool of investors. We have a process. We use an SPV. We put together a special purpose vehicle, like an LLC. All the investors come into that, and then we invest directly in that farm or ranch if it's equity, or we give them a loan. So we're kind of in the middle of the process. We do the due diligence, but then it's ultimately up to our investors to decide if they want to come in and invest in that particular farming syndication.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So you've been around real estate for decades. What is one of the reasons or some of the reasons why you would inform or stress to investors that maybe are to diversify out of maybe, I don't want to say traditional, but maybe your traditional real estate classes and
Mhm.
into farming investments?
Yeah, I mean that diversification is probably the key and most important aspect when you're investing in real estate. People choose what their category is, whether that's multifamily or single family or office or whatever, and they tend to get good at it and do it over and over again. But sometimes the markets change as they are very much in flux right now in some of those sectors. So they're looking for that next opportunity. And so for us, having investors that kind of understand the mechanics of real estate, but want to put their capital to work in something that's essentially real estate, and the farming is real estate. It's land based. Instead of tenants, you have crops or cows or whatever the situation is, depending on type of agriculture. And so diversification is that first part, something that's not correlated with the stock market, something that is based on land or the appreciation of land. And in some cases, not all cases, that the other aspect is just the demographics of that are impacting agriculture at this point. So it's if you think about it, it's the one industry that touches every single person on this earth because everybody's going to eat. Real estate is similar, but you can rent or you can buy. There's various variations, but agriculture, every single person has to eat, and someone's got to grow that food. And as we've all seen, in the past, say 36 months, the prices of food, whether you're at the grocery store, whether you're shopping, whether you're or going to a restaurant, have skyrocketed. So there's good and bad aspects of that for the farmer. But if you're an investor, that can be a very good thing with some of these commodity prices up. And the demographics to continue on that theme, the world population is still growing. That growth is supposed to plateau around 2015, but the calories consumed and the number of food, the amount of food calories that are going to have to be produced is going to exceed the rate of population growth. So where population growth is about 20% globally, it's 30% or 40% is the amount of calories that are going to be produced, because as people become wealthier, they consume more calories and more protein specifically, which is one of the reasons we like beef. And there's some other financial aspects. There's cash flow. There's appreciation, just like you might see in real estate. There's some tax benefits. You do see some things like farmers get a lot of credits, tax credits and depreciation, just things like that make it favorable for investors, just like you might see in a normal real estate type of deal.
Yeah, what I've found is we're predominantly multifamily investors, and every asset class, has pros and cons. So let's talk about some
Mhm.
of the challenges with what agriculture, farming, some of the risks of it, and maybe how you guys go about it or the operators go about mitigating it and trying to lower that downside as much as possible.
Yeah, that's really the most important question, especially these days when you're looking at, where do I allocate capital into various parts of real estate and geographies. So for agriculture, some of the risks are the same. There's macroeconomic rate risk, like real estate, and changing rates and making credit tighter for certain farmers to get access to capital, just like we might see in interest payments blowing up, just like we've seen, and so it's harder to refinance. So there's a risk there. The macroeconomic risks are very similar. There's a commodity risk in some types of agriculture, so which would be like the market risk from real estate in the form of commodity risk. Prices go up and down. So wheat, soy, those sorts of things are very well traded liquid types of commodities. Other things such as the grass-fed cattle that we deal in, it's a little bit more of a premium product, so it's not necessarily, you don't have all of those commodity-based risk. And then, of course, you're dealing with biology. So in agriculture, you have droughts, too much rain, too little rain. You have pests and insects, and you have diseases. So that's a risk. I would say the mitigation piece, there's a number of ways to do it, and it's very similar to what you might see in multifamily. Is one, a lot of it's based on the operator. So choose the right operator. Look for experience, look for somebody that has a solid plan, realistic financial projections, all those sorts of things, and sort of a proven ability to execute 100% the same as in, like, say, a multifamily deal. Then there is, some other mitigation things like insurance, choosing the right market, is important, or the right in crop type, but location. It's all very, very similar to real estate once you sort of understand the mechanics behind agriculture investing.
Yeah, it really just takes, like you said, that operator that really knows what they're doing, an experienced seasoned operator. You went on a little bit about previously about the structure of the deals, getting into how it's kind of legally structured. Can you walk us through maybe a typical deal that maybe you've seen on your platform, or maybe one that you've been a part of, whatever it might be? And what does a business plan look like? And like maybe the capitalization. So, are we borrowing money? Is it 100% no debt? I mean, how does that work?
Yeah, it varies, and like I mentioned, we'll do debt and equity. So a typical equity deal might come to us and need capital that they can put together with a loan, just like if you're raising an equity piece to go out and buy a apartment, and then you've got some permanent debt attached to that. We've done the same thing where we've helped kind of raise the down payment, bring in equity investors. Those investors are going to be exited. They're very similar methods. Cash flow um, is one way. Stabilization, refinance, hopefully when rates are a little bit more favorable. And then, the third is some sort of liquidity event. They sell the farm, sell the business, and we produce the investor ultimate exit. And we'll have a waterfall structure that might be pretty similar to what you might see in real estate. And on the debt side, it's a little different. Somebody might come to us and want to, they've got 1,000 cattle and they want to have 2,000 cattle, and they've got the land to do that, or they need to expand their land or improve their land in order to accommodate those cattle. We've seen both those things. So we might do a 2 or 3 year note, quarterly interest payments, small prepayment penalty, and they use that, and we'll collateralize it with a lien on the land, maybe a second lien on the land, and first lien on the cattle. It just varies. I mean, the ranchers that we work with, they like working with us because we're a little bit more creative than them going to the bank. Rates that we're seeing right now on debt are, maybe 10 to 15%, depending on what it is, what the collateral is. So it's pretty decent. You're definitely, we understand you've got to get that. We're competing right now in this environment with like a 5% sort of risk-free rate with CDs or treasuries or whatever. So you got to have a little bit more juice to attract investors. And on the equity side, it might be, 20, high 20s, something like that is what we sort of try to structure with some capital payments and then exit. And, exit time period for equity could be 3 to 7 years. Debt is usually shorter.
Yeah, that's great. I had no idea that you guys also worked in debt. So that's a very interesting,
Mhm.
expanding. That's a great business model because you're expanding something that's already working and someone already has a proven method, and you're really just kind of pouring a little gas on that.
Mhm.
So obviously, this is we were talking about this is for most investors. This is a little different of an asset class. I imagine there's a lot of education that goes into educating people, like we're doing here, or what you're doing to me, and how do you usually do that with new investors? How have you found it the most efficient with, you have a whole platform, imagine you have thousands of investors, thousands of people on there. How have you efficiently been able to educate potential investors in your industry and the opportunities that your firm has?
Yeah, some of that it's very important because this is a new asset class that a lot of people have never been exposed to. So, we have some educational content on the website, blogs, and things like that. We'll do an investor webinar for every single deal. So that gives investors the opportunity to ask questions to us and to the deal sponsor operator in real time. And then there's many opportunities for direct connections between the investors, and they can go out and visit the farming operation during due diligence or after the investment period if they'd like to. So a lot of different ways. It's like anything else, you learn by repeating over and over again. So we tend to just talk until the investors are sick of listening, and then they get to make up their mind.
When you've spoken to investors that maybe have lost money or made mistakes with farming and agriculture investments, what are common what do you hear are those common ways or reasons why that's happened?
Yeah, I mean, we like anybody else that's been in the business for a while. We've unfortunately lost some money. We've made some money. That's the way it goes. And some of our investors have lost money. And sort of the commonalities that, of course, there was COVID, which didn't do really any business favors. So that was just one of those unforeseen circumstances that caused a lot of small businesses, and most farmers are small businesses, to have challenges, because of supply chain issues, things like that. I would put that in this sort of unforeseen circumstance place, black swan event, whatever you want to call it. But then there's others where assumptions were made that proved to be inaccurate. In some cases, those were, obvious in hindsight, and others they weren't. And I think, unfortunately, investing is one of those things, especially when you're investing. You're not just giving your money to your financial planner and saying dump it in the S&P 500. The type of investors I think that most real estate investors are, where they want to have some control over what they're allocating into. That comes with risk. So definitely understand risk, and people not understanding that they can lose money in some situations. If that's the case and they're not comfortable with that, then they shouldn't be investing. At least not large percentage of their portfolio. You can talk to professional institutional money managers, and they'll say, you'll hear anywhere between 5 and 40%, those ranges, to go into alternative investments, of which real estate and agriculture and other types of off the beaten track non-stocks markets. But it's also has a lot of potential for profitability, because like real estate, agriculture is fairly illiquid, and that illiquidity comes with a premium, so you can get outsized returns from that. You're finding deals where there's opportunity that the average investor doesn't have. And those people that are sort of turned off by the stock market because they've lost money in the stock market, and I think most people have, if they've invested any amount of time in the stock market, especially into like individual stocks, where you don't have control. I can go out and buy Apple stock or Tesla or whatever, and maybe I do really well if I buy at the right timing, or maybe I lose a lot of money really quickly, just because of what the market's doing. And you have a lot of liquidity there, but you also have the potential to lose money. One of my first investment loss experiences was in a public company, Enron. I lost a lot of money in like a very rapid period of time, as well as many others did. And in that case, that was fraud, unfortunately, as the courts eventually proved. But it was also it was investing in something I didn't fully understand, and I don't think many people understood what the heck Enron was trying to do with their sort of complicated derivatives models and things.
Yeah, investing in what you understand. It's such an important thing, so simple. And I mean, I think every investor has made that mistake one time during their career. But what advice? I mean, other than picking the operator, because obviously with anything like this, it's really buying the operator. You're buying, if you're you're finding the operator that works well, whether you're investing in a mutual fund, finding the operator that does that, whether you're investing into some sort of private placement memorandum. What do you find, for other than the operator, is most important for people passively investing in farming and agriculture?
Yeah, understand ideal terms. So understand what the payout looks like, the waterfall, if that's the way it's structured. Understand, as we discussed, those risk mitigation pieces in place. What's the maximum I could lose? Is it 100%, or is there some other amount because of the way the mitigation is in place? Know the duration. Make sure you're comfortable with the term, expected term. If you're dealing equity, the expected term is usually not what one thinks it's going to be. It's either shorter or longer. It's rarely, hey, I'm going to exit in 3 years. Well, an opportunity comes along to get an early exit, or maybe market changes or whatever, and you're stuck holding that property or that deal for a longer period of time. And you have to be prepared for all those. So just don't invest unless you really understand what you're getting into.
So over all the years of starting with being around your dad's business, going into public, the military, and then working in Pentagon and everything else, kind of how has your relationship towards money changed in the decades that you have been present around real estate, investing, and business in general?
Yeah, I mean, it's interesting, because I think some people, as they get older, they get more risk averse, but I think for me, it's almost the opposite. I've been more likely to take risk, and I think that's because I've just become comfortable and I understand what those risks are, and I know that I'm not going to invest something that I can't afford to lose, even though I might invest in a project that I might lose money on. I've invested in some early stage companies outside of our business, and lost some money and made some money and have some money on paper. You just never, if you take that approach that I'm comfortable doing this, and this I'm not uncomfortable taking these risks, then I think that's the way to invest. And that applies whether you're very conservative, risk averse, or you're like the opposite, which I think most people are somewhere in the middle, where they don't want to lose money, but if they do lose a little bit of money, they're not going to be too emotionally bent. And there's all kinds of behavioral psychology on investors. It's very, very interesting. It does, and if you look at some of that, it helps you understand your own sort of investment philosophy.
Yeah, that makes perfect sense. So, Chris, thank you so much for coming on today. How can our listeners learn more about you and Harvest Returns?
Yeah, Charles, thanks. Best way is to go to our website, harvestreturns.com. And we're on social media, so you can find us that way too: Facebook, LinkedIn, all those things, and search engines, whatever. Harvest Returns, you can find us.
All right. Well, thank you so much for coming on today, Chris, and looking forward to connecting with you here in the near future.
Sounds great.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.